So we've got somebody who's almost an authority in the space now, big fan following. Everybody listens to, and I'm talking about my friend Aditya Khemka, who is now joining us from InCred. Aditya, good afternoon. Thank you so much for your time. Congratulations on your new role. Let's start by understanding your the commentary, recent developments which are happening in the healthcare space. For example, biosimilars. That end of the healthcare market is getting a lot of limelight, not only because of Biocon, but last night the commentary coming in from Cipla's call. Let's talk about these elements which are now taking shape in a bigger fashion. Institutional money is looking at these early kind of areas which are growing now here in India. No stock specific call, but the area.
Sure. So good afternoon, Ajay, and thanks for your wishes. So biosimilars is, as you said, it's a very nascent area. It's a very new area for all the pharma companies, including Biocons across the world. And it's an area with a lot of potential for growth. However, we also need to understand that this is an uncharted territory. This is something that Indian companies have not done before. In fact, nobody in the world has done biosimilars before. What we are experiencing is the first wave of this kind of products. So we have seen biologics, but we have not seen biosimilars for so long. So we don't really have a track record or something, an experience in the industry to see how it would shape up. So it's a very, very exciting area. It's an area with a lot of potential for growth. However, what I am not very sure of, and what we as an industry are not very sure of, is how sustainable will it be and how profitable will it be. Remember, biosimilars cost a lot to develop. I mean, company to company, we hear estimates of $50 million to $200 million to develop one asset in a biosimilar category. And when you spend $50 to $200 million to develop an asset, you better make very sustainable, good margins in that product to justify that kind of an investment. And it takes anywhere between 2 to 5 years to develop a biosimilar product. So while the opportunity is out there, the opportunity is in front of each of us. The question to be asked right now, in my view, is despite investing so much money, can you really be very profitable, and can the profitability be very sustainable? Also, please do keep in mind, when you develop biosimilars and you sell biosimilars in the global markets, you are essentially competing with the large innovators who are also developing biosimilars. So Pfizer's, the Amgens of the world are also doing biosimilars. So you're going head to head with those guys in a field where they have been dominant for a very long while, and you are just new entrants. And in biosimilars, I'm not so sure whether the Indian companies have that kind of a cost advantage as we do have in the small molecule space, the chemical drug space. So it's an uncharted territory in a way, but yeah, the opportunity is huge. It's very exciting and it's very, very new.
There, if we've got you on a scratchy line, we'll just reconnect with you in just a moment. We'll just try and reconnect. Maybe the line improves. We'll just tell you exactly what is your house view as far as the space goes, the healthcare space. Meanwhile, we'll get you back. Aditya, believe that the multiples as far as the pharma space is concerned right now are in line with the historical average. They may not be very steep discount, say what they were 2 to 3 years back, but at the same time, there is the reason why there is room for improvement is because they are just meandering around their historical average. Also, ROEs are consistently improving. And the peak ROEs, as far as this space is concerned, were closer to 24%. Right now, the ROEs are just at average. So they have much more room to expand. And if ROEs expand, obviously, the stock market prices will also expand. We'll just get Aditya back. Aditya, do we have you back? Right. So you were explaining about biologics. Did you catch, Aditya, the news report today which ET put out on Suvin? That is also being eyed by a clutch of private equity companies. Earlier it was JB Chem, which KKR actually bought out. There have been so many buyouts in the pharma space in the last 1 year from private equity side. What is your analysis? What kind of companies are these big institutional blue-blooded investors chasing, and why there is so much of scramble to buy out pharma and a bit pharma-related chemical assets here in India, in your view?
Yeah, so, it just makes a lot of sense for private equity players to be a part of the pharmaceutical a biosimilar portfolio in India, simply because biosimilars is, as I said, a very new area, an area which is relatively underexplored. And you have companies which are launching biosimilar products out of India and can do tremendous amount of growth in the near future for the next 5 to 10 years, I would say. However, these investors, when they create such, when they buy such companies, they create portfolios. They don't buy only one asset; they buy multiple assets. And the assumption is that one or two assets which they buy will not do very well, but they have other assets which will do well. So the key question to my mind is, when they buy, let's say, a couple of Indian assets, a couple of Korean assets, and maybe 3, 4 American assets, which assets will actually end up doing well in this area? And that is something we haven't seen a track record there. We don't know if the Indian companies can compete with these innovators in biologics when it comes to biosimilars, and can they effectively get market share, and can they retain that market share over long periods of time with effective profitability? So that's the question I'm really asking. And the private equity excitement is understandable because they are creating a basket of companies. They are hoping and praying that out of 10 bets that they take, 6, 7 bets pay off, and their return on equity will be fantastic.
Right. Aditya, how are you forming your portfolio here at InCred? I understand you'll be, leading a healthcare fund, which I'm assuming would have non-pharma bets like diagnostic, hospitals. Hospital was an 8-9 year bear market. It was seen as big, organizations which are having big assets, asset-heavy kind of models, and require capex and utilizations were low. But the way people have started looking at hospitals and diagnostics over the last 12 to 15 months have completely changed. What exactly has happened in that space? And talk to us about your portfolio approach. What kind of plays would you be having in your healthcare fund here at InCred?
Sure. So a lion's share of the portfolio, Ajay, would still be pharma companies, but this pharma companies would not be, the large cap pharma companies that we are generally used to discussing. We will have a few large caps here and there, but our major concentration will be in the small and mid cap pharma companies, simply because the small and mid cap pharma companies get a larger chunk of their revenue and profit from the domestic market, which according to me is more like a FMCG market to get the revenue and profit from. And therefore, those cash flows are very, very sticky and sustainable. And those cash flows grow year over year. Whereas the larger companies get a larger part of their profit and cash flow from the US market, which is like a commodity market.
I can hear you. Can you hear me?
Cash flow coming from these US market, which is a market which gives a lot of volatility in terms of profit and cash flow. And therefore, we'll be sticking with more consistent companies. These are the smaller and mid-cap companies and not the larger ones. So that's the pharma space. As you said, we'll be taking a big bet on the healthcare delivery sector as well, which include hospital and diagnostics. Amongst hospitals, as you said, they are coming out of a 8-9 year sort of investment cycle. So, hospitals, you need to look at them as retail stores. Once you open a new store, the new store makes losses for 3-4 years. And then eventually they start giving you profit once the store matures. Right now, because most of these hospitals have opened so many stores in the past 5 to 6 years, their older hospitals, as they have matured, they're giving more profit, but they're getting new losses from the new capacities. Going forward, the capex of these hospitals is dying down. And as the capex goes down, your newer capacities become more profitable. Your older capacities, as it is, were always profitable. So both put together, now the profitability of the company will start looking better. The cash flow will start looking better. The debt will go down. The ROE will start looking better. And therefore, the stocks will do significantly better. So that's my expectation on the hospital side. On the diagnostics, it's a very clear-cut story. 80% of the Indian diagnostic market is still unorganized. Only 20% of the market is organized. And the diagnostic sector in India itself is growing at 10-12%. So if you have the organized sector gaining share over the unorganized sector, the unorganized sector will grow. The organized sector will grow faster than 10-12%. So therefore, they have a long runway for growth, and brand has incrementally gained value. In terms of the diagnostics. Earlier, we didn't mind which diagnostic center we go to. Now, people have become more brand conscious about which diagnostic center they want to go to. And therefore, these organized larger players will benefit a lot from that transition of unorganized to organized. So I'm extremely bullish on both hospitals and diagnostics as well.
Aditya, if really one looks at the entire landscape of, it's not one. Pharma is a very loose term actually. I look at it more as a chemicals play. Pharma is one part of it, agrochemical, specialty, all of that. But if we look at this entire complex space, there are large Indian companies which are now upping their R&D plays, which were very few product dominated, say Lupin's, Sun, all of them, Cadila are upping their R&D play. Then there are chronics, the company which look at chronic ailments. There are smaller API companies apart from Divi's which are raising their API opportunity, China plus one, etc. And then there are some which are solely looking at domestic market, and they are almost wanting to get a OTC valuations also, quasi consumer, which of and all of this entire bouquet trades at different valuations, each category. Where would you see is the biggest earnings alpha in the next 3 years?
So the earnings alpha will be significantly higher in my view in the API names. Ajay, so the Chinese geography exports API and intermediates worth about $30 to $40 billion. India as a country exports API and intermediates worth up to $4 or $5 billion. Given the entire China plus one rhetoric going globally across companies, if China loses 10 or 20% of their market share, Indian API players can actually double or treble their revenues. The simple mathematics there. So I think the largest earnings delta is going to definitely come in the API companies that we look at, which includes the name that you gave, Divi's plus many other smaller API companies. They're all starting, a lot of capex to accommodate the demand which they're already experiencing from various customers. So I have absolutely no doubt in my mind that the largest earning delta is going to come in a majority of the API companies. Coming to the specialty part of the pharma space, so in specialty, companies like Sun Pharma, Dr. Reddy's, Lupin, Cadila, they're all investing a lot. But please understand, specialty as a space is not a space that can pay you off as an investor in next 1 or 2 years. When these promoters are starting this business or investing in this business, they're actually investing over a 10, 15-year time horizon. They don't expect the results of these kind of investments to pay off in 3 or 4 years, right? They are looking at 5, 10, 15 years. So as an investor, when you want to invest in specialty companies, you better have the same time horizon as the promoter has when he's initiating in these businesses, when he's investing in these businesses. If you don't have the same time horizon, it doesn't make sense for you to invest in these companies for their specialty assets, right? Then you spoke of the domestic, business, the OTC side of the business in India. I think that's a space which will be a very consistent compounder. It will not give you 30, 40% earning growth next year. That's not going to happen. It will give you 10, 20% earning growth, anywhere in that range, depending on company to company. And that they will give you for a very long period of time consistently. So, those are the stocks you want to have in your portfolio if you want to have a portfolio that can consistently show you growth rather than a portfolio which can show you 80, 90% growth in 1 year, 5 year down the line. If you want 10% growth every year, then these are the kind of stocks you want to have in your portfolio. Lastly, you spoke of, these complex generic assets and, the US assets. So, again, there I think the ambiguity is slightly higher. These are sort of bets which can pay off very fast in a very, short period of time. But it is very difficult to estimate when they will pay off, how much they will pay off. So there is always a lot of volatility in earnings of companies that invest in such assets. So again, my preference in the ranking order will be to go with the consistent compounders, which is the domestic OTC opportunity. Then maybe have the API hospital diagnostics, because these are seeing big delta in earnings given the environment where it is. And then maybe have some of these specialty assets, some of the US complex generic assets. But they will be like the lowest weight in my portfolio compared to the others.
All right, Aditya, always wonderful to chat with you. Thanks so much. I wish we had more time. That was Aditya Khemka of InCred talking about opportunities and analyzing situations in the various parts of the healthcare space. Time for a break. We'll talk about IT and earning previews on the other side of this break.